Power does not begin with weapons. It begins with systems. Before crowns were forged, before borders were drawn, before empires expanded, there were records, numbers carved into stone, promises tracked across years, debt remembered longer than bloodlines. History does not celebrate bankers, but history always depends on them. This is not a story of motivation. This is not belief. This is financial history. And financial history shows one reality. Civilizations rise when money is organized. They collapse when it is not. The earliest evidence of organized finance appears in ancient Mesopotamia. Around 5,000 years ago, temples and royal institutions functioned as financial centers. Grain and silver were deposited for safekeeping. Quantities were measured. Ownership was recorded. Clay tablets documented obligations with precision. Loans were issued to farmers and traders. Interest was applied. Repayment terms were defined. Debt could be transferred. These activities represent the first known banking systems in recorded history. In Babylon, finance became regulated by law. Around 1800 BCE, the Code of Hammurabi established standardized rules for lending. It defined interest limits, collateral requirements, repayment schedules, and penalties for default. Financial agreements gained legal enforcement. Credit became a matter of state authority. In ancient Egypt, wealth was administered through centralized systems. Agricultural surplus flowed into state-controlled granaries. Grain was recorded, stored, and redistributed. Receipts represented value. Payments for labor, taxation, and distribution relied on accounting. Financial administration supported political stability. As trade expanded across the Mediterranean, finance evolved further. In ancient Greece, private bankers operated in marketplaces. They exchanged currencies, accepted deposits, and financed commercial ventures. Maritime trade required capital before profit could be realized. Banking enabled commerce across long distances. In ancient Rome, finance became institutionalized. Professional bankers managed deposits, payments, and loans. Transactions were recorded publicly. Roman law recognized contracts and enforced debt. Courts upheld financial obligations. Banking supported infrastructure, administration, and military supply across the empire. When Roman authority declined, financial systems fragmented. Coin circulation decreased. Long-distance trade diminished. Wealth shifted toward land ownership. Organized banking faded alongside political unity. Between the 8th and 13th centuries, financial innovation expanded through Islamic trade networks. Merchants used written payment instruments to settle obligations. Partnerships pooled capital for trade. Profits and losses were shared according to agreements. Accounting methods advanced. Capital moved without physical transfer of precious metals. As European trade revived, Italian city-states emerged as financial leaders. Florence, Venice, and Genoa financed commerce, governments, and military campaigns. Merchant banks operated branches across regions. Capital traveled through correspondence rather than caravans. In the 14th century, double-entry bookkeeping was formalized. Each transaction was recorded with equal debit and credit. Financial accuracy increased. Errors became visible. Control improved. Accounting became a foundation of commercial expansion. The Medici Bank expanded banking across Europe through branch networks. Letters of credit reduced transport risk. Currency exchange produced revenue. Financial influence translated into political authority. Banking families shaped policy through credit. During the period of global exploration, precious metals entered European economies in large quantities. Money supply expanded rapidly. Prices increased. Inflation altered economic structures. Financial institutions adapted to larger volumes of capital and greater volatility. In 1602, the Dutch East India Company introduced divided ownership through shares. Investors funded voyages collectively. Risk was distributed. Ownership was transferable. The joint stock corporation emerged as a durable financial structure. The Amsterdam Stock Exchange organized regular securities trading. Shares changed hands frequently. Prices reflected information and expectation. Capital markets became continuous rather than episodic. In 1694, the Bank of England was established to finance government debt. In exchange, it gained authority to issue banknotes. Public credit stabilized state finances. Central banking began to take institutional form. Paper currency expanded across economies. Banks transformed deposits into loans. Credit multiplied economic activity. Trust replaced metal in daily exchange. In the 18th century, insurance markets matured. Maritime insurance protected cargo and ships from loss. Risk became quantifiable. Loss became transferable. Commerce expanded with reduced uncertainty. The Industrial Revolution reshaped finance. Factories, machinery, and transportation networks required long-term investment. Joint stock companies multiplied. Banks redirected savings into industrial production. In the 19th century, national banking systems formed. Central banks regulated currency issuance and reserves. Gold standards linked money to fixed value. Exchange rates stabilized international trade. Investment banks underwrote bonds and shares. Governments financed infrastructure. Corporations expanded production. Capital markets integrated across borders. In the United States, early national banks were created to stabilize currency and credit. Political conflict disrupted these institutions. Periods of instability followed. History recorded the effects of fragmented financial authority. By the late 19th century, London emerged as the global financial center. Capital flowed through its banks and exchanges. International trade depended on financial confidence. In 1913, the Federal Reserve System centralized monetary authority. It coordinated credit conditions. It formalized the lender of last resort role. Modern monetary governance took shape. In the early 20th century, financial markets interconnected rapidly. Capital mobility increased. Leverage expanded. Speculation intensified. Systems grew faster than safeguards. In 1929, markets collapsed. Banks failed. Credit contracted. Economic depression followed. Governments restructured financial systems. Regulation expanded. Stability became a priority. Across all eras, one pattern remains consistent. Finance enables scale. Credit enables continuity. Structure enables survival. Empires rely on organized money. Trade relies on trust. Growth relies on investment. History records this without emotion, without motivation, without opinion. Money did not conquer the world loudly. It structured it quietly, through ledgers, through contracts, through systems. This is how power endured. This is how history moved.